Well, with me to discuss the U.S. economy as well as Europe's ongoing debt troubles is Andreas Utermann. He's the Chief Investment Officer at RCM, where he helps oversee more than $140 billion in assets. Andreas, thank you so much for being in the studio. Now, looking at your portfolios, you actually say that the overall asset allocation is unchanged from last month. However, you're a lot more cautious about some of the peripheral countries' debt.
Well, we continue to be cautious on Portugal, Greece and Ireland, simply for the simple reason that it's going to take time to work out, and ultimately we think there's likely to be some sort of haircut, but probably after investors have breathed a sigh of relief and there is a big rally. However, we're much more constructive on Spain. We think Spain will indeed be the domino that will actually stand, and therefore we think the premiums that you're getting on Spanish debt at the moment and on some of the equity is probably a good investment opportunity.
And so in terms of Spanish debt, it's actually on the longer term, so what, the 10-year maturities?
Well, I wouldn't go out the 10-year in any bond market at the moment. I think bond markets at the longer maturities are dangerous and overvalued and manipulated. That's what the central banks with QE are trying to do. But certainly at the shorter maturities where there is a premium, that looks good deal.
And just overall, we're seeing all this unrest in Egypt, and there's a lot of concern that actually this will spread to the rest of the region, and we're going to possibly see also countries like Algeria with social unrest there, and of course they have the oil supplies. Does this just make the investors worried? Does it make you worried that we're in a much more unsettled environment?
It's obviously a concern. I think what's dominating right now is the fact that you're not getting any return on so-called safe assets. So it looks like risk assets are the only alternative in town, and people just have parked so much money into so-called safe assets that's probably dominating the agenda right now. But of course it does concern us, and who can predict what's going to happen? You know, the outcome in Egypt could either be a continuation of a dictatorship, it could be some sort of start to a free North African or maybe even Arab world, or it could be, you know, something really sinister, you know, something that happened in Iran. We don't know at the moment.
What will it take for you to actually decide that you need to change your portfolio strategy? We heard from Mr. Trichet yesterday saying that, well, he's cautiously optimistic about the future, but certainly there was no clear indication that rates will rise sooner rather than later. Is that the clinching point? When interest rates start rising, we're going to see so much liquidity coming out of the markets?
I don't think so. I think initially, at least, people are going to be quite relieved when interest rates rise, because they'll see that the cost of capital is now normalized. They'll feel that the central banks are now convinced that the recovery is there to stay, and that should really be, at least initially, good for equities. Longer term, obviously, as inflation concerns rise, we'll need to see whether central banks are in effect able to sterilize the quantitative easing that they've put in place. But I think the key concern for us in markets is political as well as trade and currency tensions. We need, for the global imbalances to get resolved and equalized, we need the global trade system to continue to be open and free.
For the moment, you're confident that the U.S. will continue growing. We have this important jobs data, and it's actually ticking along nicely.
It looks very good at the moment. It looks like quantitative easing is working. All the indicators, ISM, consumer confidence and so on, are very positive. I think the real clinching point for us to get really, really bullish this year would be when we see that the trade balances in the US and in China are starting to normalize, and we could see that happen in the second half of the year.
Any currency that you'd be particular player on today?
I think the dollar-euro rate is going to continue to be range-bound between about 128 and 140. I think the currencies that we've played for some time now are the emerging market currencies, but not only for the nominal gain, but also the real gain. It's clear with higher inflation rates in these countries that these currencies are gaining in real terms, and we need to position ourselves accordingly when we invest in those markets.
Andreas, thank you so much. Andreas Utermann there.